In recent economic developments, the United States witnessed unexpectedly high inflation data, creating a stark contrast with Fed fund futures, which still suggest a 72% likelihood of a March cut and multiple cuts throughout the year. This divergence between market expectations, economic indicators, and the Federal Reserve's narrative is notable. However, the focus on the dovish market sentiment might be attributed to escalating risks of a regional conflict in the Middle East, overshadowing concerns about the inflation report. Meanwhile, the Bank of Japan (BOJ) finds itself grappling with disappointing data. As household spending deflates, Tokyo's Consumer Price Index (CPI) slows, and wages take a downward turn. Initial optimism for the BOJ in Q1 appears to be dwindling. In Europe, demand for bonds reached record highs as investors hurried to secure higher yields in anticipation of further decreases. This trend reflects a nuanced market sentiment. Turning to China, the inflation picture is mixed, with a contraction of -0.3% year-on-year but a modest increase of 0.1% month-on-month. Producer prices slowed to -2.7% year-on-year. Despite this, exports rose by 2.3% year-on-year, signaling a surge in global demand. Notably, iron ore exports reached a record high, potentially boding well for the AUD-USD pair. On the Australian front, softer inflation data solidifies the Reserve Bank of Australia's decision to maintain the status quo, with the cash rate futures curve indicating that the current rate of 4.5% is likely to be the peak. US dollar. In a notable development, the US dollar has recorded its smallest weekly range since September 2021, standing at just 69 points, a remarkable occurrence during a week that included a US inflation report. Intriguingly, historical daily data signals that January 15 has historically delivered strong average returns and a high win rate for the month, adding anticipation to this upcoming Monday. The spotlight in the United States will be on retail sales, a pivotal economic indicator, amidst a backdrop of mostly second-tier data releases. While U.S. consumer spending has moderated post the summer surge, November's retail sales growth of 0.3% month-on-month is expected to be mirrored in the upcoming December readings on Wednesday. Industrial production figures on Wednesday and housing-related data on Thursday, including building permits and housing starts for December, are poised to attract attention. Friday will see the release of existing home sales data. Additionally, regional Fed surveys on Monday and Thursday, along with the University of Michigan's Consumer Sentiment Survey on Friday, will offer insights into the manufacturing sector and overall consumer confidence. Markets, currently pricing in approximately 150 basis points of rate cuts by December 2024, may experience repricing in Fed fund futures if a solid set of economic indicators emerges. This could potentially drive up Treasury yields and, subsequently, the US dollar. While bond auctions might not be closely monitored by the majority of traders, they can provide a unique perspective on sentiment and expectations of monetary policy. If inflation has indeed peaked, a sustained increase in bond demand could further weigh on yields. This week witnessed a surge in investor interest in European bonds, particularly at the long end, and a notable influx into the UK gilt market. Falling yields are currently supporting Wall Street, potentially boosting sentiment further next week if bond demand persists. However, geopolitical tensions, such as a regional conflict in the Middle East, could alter this landscape, potentially driving increased demand for bonds in a risk-off environment. Looking ahead, earnings releases from JP Morgan Chase, JPM, and Citigroup today are poised to set the tone for expectations, with Goldman Sachs GS and Morgan Stanley MS expected to report lower profits in Q4 due to souring loans. These reports provide a valuable gauge on sentiment for US and global growth. British pound GBP ***. The pound has found support amidst expectations of more moderate rate cuts compared to other central banks. While the Bank of England is anticipated to reduce rates by at least 100 basis points, the European Central Bank (ECB) and the Federal Reserve are expected to pursue more aggressive cuts. Despite a lag in the decline of UK inflation from the 2022 highs, recent reports indicate improvement, with the headline Consumer Price Index (CPI) dropping to 3.9% year-on-year in November and forecasted to cool slightly to 3.8% year-on-year in December. Core CPI, remaining above 5.0%, will be closely monitored, and job and wage data for November are expected earlier in the week. Retail sales figures on Friday will be pivotal for assessing the pound's performance. Canadian dollar CAD ***. The Canadian dollar staged an impressive rebound in late 2023, driven by a weakened US dollar and improved risk appetite, despite a decline in oil prices. The focus in the upcoming week will shift to the domestic economy with the release of the latest Consumer Price Index (CPI) on Tuesday. November's CPI held at 3.1% year-on-year, signaling a potential challenge in meeting the Bank of Canada's 2% target midpoint. A drop in core figures may counterbalance an unexpectedly high headline number, impacting the loonie's performance. The currency's medium-term trajectory will be influenced by evolving Fed expectations and oil prices. Japanese yen (JPY***). The Japanese yen faced challenges in the early part of 2024, with expectations of a policy shift by the Bank of Japan fading after a New Year's Day earthquake. Friday's projected CPI easing from 2.5% to 2.3% year-on-year in December adds to the yen's setbacks. While a reacceleration of inflation in Japan is unlikely, policymakers may consider adjustments if it remains above 2%. The yen's reaction to December CPI data is expected to be muted, with other releases next week including corporate goods prices on Tuesday and machinery orders on Thursday. Australian dollar AUD ***. Beyond monitoring China's economic performance, Australian traders will focus on Thursday's employment numbers. Despite a slight cooling of Australia's labour market in recent months, with the unemployment rate inching up to 3.9%, the Reserve Bank of Australia (RBA) is perceived as the least dovish among major central banks, contributing to the local dollar's revival. If the employment report indicates further weakness in December, investors may increase bets on RBA rate cuts in 2024. The Aussie's performance against the US dollar will depend on the extent of these rate cut expectations and the prevailing sentiment about China. China. Title: APAC Economic Outlook. Navigating China's economic landscape and global implications. As weak inflation data from China and mixed trade dynamics influenced APAC risk sentiment on Friday, hopes for stimulus emerged, creating a slight bid. The release of China's quarterly GDP report, alongside crucial indicators such as retail sales, industrial production, and investment, next week could intensify calls for stimulus and impact global risk sentiment. A weak report might further bolster support for stimulus measures, but the prospect of stronger than expected data could contribute to a more robust global growth recovery. In 2023, the Chinese economy faced challenges, particularly amid a worsening property crisis. Markets anticipated a significant stimulus response, but authorities, balancing the need for deleveraging, implemented targeted measures. While these measures left some investors flabbergasted and disappointed, signs are emerging that the Chinese economy is stabilizing. Consumer spending has increased since the summer, and industrial production is rebounding. Although the property sector remains a concern, there are indications of stabilization. Consequently, GDP growth is expected to accelerate in the final quarter of 2023 to 5.3% year-on-year, following a slowdown to 4.9% year-on-year in Q3. A Q4 reading slightly above 5.0% year-on-year would align with the government's growth target of around 5.0% for the full year. Wednesday's release of GDP data, along with monthly indicators on industrial output, retail sales, and fixed asset investment, will be closely watched. A positive outcome could lead to gains in global equities and the Australian dollar, considered a liquid proxy for China-related risks. The potential for a stronger economic performance in the world's second-largest economy presents opportunities for broader global economic recovery.